Manny, thanks once again. It's probably been about a year since we spoke last, actually. So yeah, hope you've been well. Look, we've done some chats on ECP and flagship and global masters more generally on who you are and the strategy. So given how markets have been capitulating lately, just thinking about the fact that you've been recognised in quality growth companies investing there, do you see yourself in that bucket as a growth investor and investing in quality businesses?
Well, I mean, that's the bucket that we get put into, as I've said. Our underlying investment philosophy is that the economics of the business determines the long-term returns you're going to get from the investment. And obviously, when you're looking over the longer term, the business has to be sound, sustainable, to be able to deliver those economic returns in the long term. And we look to invest in something that can, through the business, increase its economic footprint. So we're certainly not interested in buying something because it's cheap at this point in time, which maybe is what the value guys do. We're about buying a particular business because we believe in the economics of that business, and we would want to see that expanding over time. So that's what puts us in the growth box, because we want to see a business getting bigger. But clearly the valuation comes into it at some point, because you don't want to overpay for the assets, otherwise you never make any money. So there is that sort of value component that comes in at the end. It's all about the business and its ability to be resilient in these kind of times and how they're expanding their economic footprint. So yeah, certainly we're still in that bucket, and we've never changed our spots.
And then considering that global equity markets have been, and fixed income for that matter, have been very, very volatile since COVID. Is it surprising at all the heavy drawdowns there in growth stocks and some other particular areas of the market, consumer discretionary or information technology?
Well, I've been through the 87 crash and various others, the GFC, etc. And anytime you see investors being worried and discounting future earnings at a higher rate than what they were previously, you get this massive contraction in the valuation. I mean, that's the space. That's what always happens, without a doubt. Future earnings are discounted massively, and you get a decline in the value of these growth type assets, because their valuation is dependent on earnings in the future, and be it 3, 5, 10 years. So if you're discounting those earnings at a massive rate, obviously the valuation today comes down. So that's not unusual for us. I mean, we always get asked, when do you underperform? And the first answer to that question is when interest rates are rising and the discount rates are under pressure. So yeah, it's not unusual, and we recognize that. I mean, obviously we try and be on the right side of our cash holdings when we see that coming up, but that certainly is what happens. The piece that a lot of short-term investors don't really get is that as soon as those quality companies report, and that might lead into a question you're going to ask a little later on, and they deliver better than expected earnings, then people turn around and say, oh my goodness, those future earnings that we were thought that are under threat now, and we're discounting them at a higher rate, they're certainly not under threat, and it looks like these companies are going to outperform. And then you get the price starting to go up a lot quicker than what you expect. So yes, we do expect a massive decline in the valuation of growth style companies when the discount rates start going up, but we do look for that to reverse sooner rather than later, and it seems like it's happening sooner rather than later in this case.
Yeah, you've guessed my question pretty much entirely. Yeah, just looking at the calendar, we're late August coming into September. What's been the results more generally? And I'm thinking about the mandate with flagship and your LIC domestically. How have companies been holding up? There's been, I tend to grimace every time the word inflation comes around. How have companies been faring across the board?
Well, we're sort of 2/3 of the way through reporting season, and it's been a very interesting period, because even companies where, for example, our earnings might have been slightly lower than the consensus view, and the companies reported sort of in line with us or slightly below us, which meant that they were below the consensus view, the stocks have been up on the day. And I mean, that's always a nervous thing for us, is that if they underperform where consensus is, then you normally get hammered on the day. This hasn't happened to the stocks that we're in. So what it suggests is that over the past 6 months, that part of the market has absolutely been hammered to a level where investors really think it's been overdone, or the bulk of the market thinks it's really been overdone, because in some instances where the results were okay but nothing to shout home about, the prices were up slightly on the day, and where they really came up with excellent results, they were up 8, 9, 10% on the day. So it just suggests that the massive decline in the market has been overdone, particularly up until a couple of days ago and including today. I mean, today Lovisa reported, which is one that's in the portfolio, and I think the rest of the market is down a couple of percent, whereas it was up. So that's just reinforced what I've been saying, is that these quality, sustainable businesses have been overdone, and that's been reflected in the share prices.
Do you think now is a good time for active investing then? I mean, there's quite a lot of gyrations, and as you alluded to, I feel there's quite a clear disconnect between the general perception in the market versus how companies are actually performing. And look, even on the weekend, commentary from the Federal Reserve and Chairman Jerome Powell, saying there, part of the commentary was that there's been a lot of speculation, I suppose, around interest rates, but pretty much reaffirming that hawkish stance that they're going to keep increasing interest rates, and at a consistent pace until that inflation comes under hand. Look, I suppose with growth investing, a lot of those future cash flows and the chunkier ones are out far into the future. How do you quantify risk at ECP? Is that a general whack approach, or any particular overheads that you can see in the near term, or is there or should there be different risk classing for different companies that doesn't boil down to purely an increasing interest rate per se?
No, I mean, we obviously just so as part of our whole calculation, we weight the portfolio according to internal rate of return. The internal rate of return has a terminal value associated with it. So just so that I can take a step back, the reason we use internal rate of return is because it's actually the same calculation as the yield to maturity in the bond market, and then you can have a look at what our portfolio is going to produce as a portfolio versus what's happening in the bond market. And if we don't get a premium, then clearly we should be in cash or in some sort of bond where we get a fixed interest return. So we calculate internal rate of return. That terminal valuation, there's a number of ways of determining that, but one of them is actually to look at the cost of capital for a particular company. And then you have to take a view on how that company rates compared to what you might believe the cost of capital is for the Australian market, or if you're in the global market per se. But it comes down to the individual company. So we sit and we have a look at that particular company. We look at the historical weighted average cost of capital. We take a view on where we think that's likely to go as the company either grows or it matures. And then that's what we apply to determining that terminal valuation. And that determines the holding that we have in that particular stock. But right up front, it's all about the business, and that calculation doesn't even come into it when we're looking at the stocks that should be in the portfolio. It's all about that business and how it performs. And in an environment like we've got at the moment, our companies have basically net cash. So when you've got an interest rate environment where the interest rates are rising, that's obviously a slight benefit to the companies. I mean, when the cash goes from 1% to 2% or 3 or 5, it's neither here nor there when they're growing earnings at 15, 20%. But it still is an additional kicker to that company. So we don't have companies that have got massive debt in terms of the old measure of debt to equity. And then when the interest rates go up, they get actually hammered because they can't service the debt. That's one of the key metrics that we look at right up front to determine whether we want to invest in something, is their ability to withstand increases in interest rates through the business cycle. So we want businesses to survive through the business cycle. The last thing we would want is to be owning in a concentrated portfolio a company that goes to the wall because interest rates have gone from 5 to 10%. That's not in our interest, and we get rid of them right early on in the piece. So in an environment where interest rates are rising, there is a slight kicker The issue is to investors is that the multiples get affected, but the business per se, it's neither here nor there.
Yep. And on those multiples, I suppose too, do you think that will be the re-rating if the earnings stay true, and maybe shifting tracks and thinking about that on a global perspective, even within the GFL portfolio, there's a bit of exposure there to the US through Berkshire and a bit in UK companies too. Any comments more broadly on the global outlook there?
Well, again, I mean, we're not a macro manager, and the macros, as we've just discussed with regard to the Aussie portfolio, do have an impact. I mean, that whole rising tide or falling tide, all the boats go the same way, and we're not immune to what's going on in the broader market, whether it be in the UK or the US. But at the end of the day, it comes down to our ability to stock pick and our ability to put decent businesses into the portfolio, because that's what gives us the outperformance over time, is these great businesses that are managed by a management team that know exactly what they're doing. And that's what we hang our hat on. I mean, we're a 5-second armchair expert and have no idea of the levers that management pull. I mean, we were discussing earlier on Dominos as a stock in the portfolio, which has been there for a long time. And when we were busy talking to management, obviously, about the Japanese operation or the European operations and the impact of inflation flowing through, the thing that struck me is they said, well, yes, it is flowing through, but we've got levers that we can pull that will reduce the impact of that. So what are those? To give us an illustration. And they pointed to specifically if you've got a store in Whoop Whoop and you're servicing a 20-kilometer radius around there by delivering your pizzas to these sort of people, when fuel goes up like it's gone up dramatically around the globe, instead of delivering to 20 or 30 Ks from where your store is, you say, no, we'll only deliver to 15 Ks. So you then save on that additional fuel. The question is, are you going to sell the same number of pizzas? Well, obviously, you do a bit of a marketing effort to make sure that closer to home people are ordering from you. But those are the sort of levers that they pull, which us sitting where we sit have no idea what they're doing. And that's an internal decision as to how they're going to improve their operating efficiencies, et cetera. And that's what we rely on. And a lot of the work we do is to see how the management team have performed under various economic cycles and whether they can continue to perform through the downturn. So when you compare and we interview competitors in the UK for Domino's in the UK or Domino's here, and without a doubt, whether it be Pizza Hut or whoever we've spoken to, the comment has always been that Domino's is at the forefront of using technology to reduce the costs of producing the pizza, whether it be looking at optimizing the energy that you spend in the store, in the ovens, and predicting when the flows are going to be, to this sort of thing. And that's what we rely on. So we hang our hat on the management actually delivering through tough circumstances. And I'll use the example. Recently, as I was saying to somebody earlier, I went to Europe to see what was going on, particularly some places close to Eastern Europe. And I read an article that said that the whole NATO philosophy around conducting a war like they're conducting, or not they're conducting, but the way the Ukraine has played out versus the Russians, is to change from this command and control system the Americans favored, where they could sit in Washington and tell everybody how to fight the war, to the Ukraine has been more strategic, with the guys on the ground have got a broad plan, but they make the decision there and then as to what they're going to do and how they're going to deal with the threat. And that's kind of what we do with the portfolios. We allow the management in the businesses, we pick them because the businesses are structured the way we want to see it, but we rely on the management team and the business model that we like to actually deliver through tough times. And that's what gets us through. And that's why, like this reporting season, the results have been better than what we expected.
Yeah, fantastic. And just thinking as well, and we sort of made the example before about JB Hi-Fi and coming back to some of those surprises that you touched on. Is there a fair bit of pessimism and even just thinking forward, any structural growth drivers more broadly within the portfolio that are possibly underappreciated when it comes to maybe consumer elasticity through the cycle? A lot of talk about possibly a hard landing that I feel has been priced in. do you feel that is incorrectly so? And, is there anything more broadly, if it's food, population, anything that sort of comes through in the portfolio to any degree?
I mean, obviously, if you look at it from a GICS classification, we're really exposed to consumer discretionary. But within that broad GICS classification, we've got the best businesses we can find in particular areas, and they might so happen to be classed as consumer discretionary, but some of them are very different. I mean, companies like car sales to real estate to Lovisa, all totally different types of businesses in different segments of that consumer discretionary space. So there's no broad theme. They just get put into that classification because the GICS is what it is. I think all the drivers are very peculiar. We don't look at a broad driver base and like plug in, we think consumer discretionary spending is going to go up by X%, and then it flows through to all the models of the underlying businesses. Each business, the drivers for that business are in the model, and that's what we look to forecast going forward. So it's peculiar to those businesses. So to answer your question, there aren't really any broad themes that I could suggest your listeners could bias because they think this is going to play out. It's very different between each of the companies. I mean, when you see what's happening between Hub and Net Wealth, those drivers are very different to what they might be in Macquarie, although they're still classed as a financial services type of company. So they're all particular to the business. There's no broad drivers that I can really point to.
Yep. And then just last one from me on that allocation too. Anything in cash at the moment, or are you fully invested?
No, we've got a bit of our cash levels are higher than what they typically have been. They were a lot higher. If you went 6 months back or so, we had been investing ahead of this reporting season. I mean, various entities have got different levels of cash, but let's say normally we would have like 3 or 4%. Our weightings are probably about 6, and they peaked at maybe at 8, 9, or 10. So they're off the peak, but still a bit higher than where they normally are. And maybe the pullback today will be using a bit of that cash to put it into the portfolio. But the last point I'd like to make relative to the portfolio is that things like flagships, and be it global or be it ECP emerging growth, because we're in the growth manager bucket, our LICs do get affected as one would expect for a manager in that space. And when you have a look at the discounts to the underlying entities, if somebody believes that growth has really been hit hard, which it has been, and you want to get back into that space, one should really look at the LICs, because you're getting those great companies at a massive discount to what you would get them ordinarily if you own them anyway. And then the entities have really sufficient earnings capability so that the dividend that you receive, which will be more than you'll get from the underlying companies, because we've got these reserves to continue paying the dividends at the level that they are. So you get an additional dividend flow, plus you're getting the really quality assets at a big discount. And that to me is the major factors that people should be thinking about when they get into an LIC like ours.
Yeah, for sure. And there tends to be quite a heavy positive correlation between the market and an LIC. So you'll see that discount extend when there's a downturn and vice versa. So it makes for a good opportunity. I guess just as well, I did say last one, I kind of lied. Just thinking, even a lot of the miners, very healthy profits, looking forward, the dividends are going to trail off. What's the exposure around there? Any reliance in terms of the actual cash flows underpinning the dividends that get paid out to shareholders? Is there a large exposure at the minute to materials and resources? Or
No. And part of our whole process in the terminal valuation revolves around cash flow. It's an assessment of the business cash flow, and to us that's all important. I mean, we need those businesses to be able to fund the growth that we expect to come. We wouldn't expect them to be coming to the market, and God forbid they come at the current time, given valuations where they are. So no, we're looking for cash flow to underpin the business and the growth in the business without a doubt. And across the board, we see that. An interesting thing is one of our institutional clients summons me to a meeting, because they were looking at the growth space, which had been inhabited probably more than the value space. And the question that they asked was, how many stocks in your portfolio are businesses that are not really sound at this point in time? It's like some IT guy that's got a fabulous idea. People have put $1 billion into it, but he still needs the revenue line to be increasing at 20, 30%. They're not operating, they're not cash flow positive, da, 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 da. How many in your portfolio are that kind of business? And the answer was very few. In fact, I think we got one, maybe two that are in that part of the business, and that's what we would call nursery. The rest of them are all very profitable, cash flow positive businesses that are there. They can support the dividend. Most of them do pay the dividend because we look at return on equity. So they're all proven businesses that are going through maybe a rough time in their business cycle, but we feel confident that the dividend increase is going to happen, as are the earnings, etc. So no, to answer your question, we're not in the speculative end of the growth spectrum, not at all. And there are managers that play in that spectrum and are very good at it. For us, we're in the growth businesses, but those that have got a proven business model that we can rely on to pay the dividend and reward our shareholders properly.
Yeah, so I assume there's a fair bit of seasoning there as well as that nursery portion comes through.
Yeah.
When does a particular degree of growth become not enough? Just thinking of your sell discipline and the turnover. What's the philosophy there?
So, I mean, if you take things like you've been mentioning JB Hi-Fi, we don't own it anymore because for us, one of the major metrics that we were looking at over time was the increase in the number of stores. Because as soon as you plateau in the number of stores, then you're into consumer discretionary spending and into your merchandising people being able to pick the goods that the client wants. So yeah, clearly they've got a great merchandising team, but consumer discretionary spending at some point is under pressure, particularly when interest rates are increasing. So Lovisa is in a similar kind of space, but their store footprint is increasing dramatically. And in fact, this whole COVID environment enabled them to sign up leases that ordinarily they wouldn't have got because they were in sites that they couldn't get into. And those people got into trouble. So for us, to answer your question as to when do you sell it down because they go X growth, we would have a metric like store rollout. When they get to a certain number of stores, we think that that's the maximum they can handle, and that's when we would get out. And that's what we did with JB Hi-Fi. So those kind of metrics are there. And when we have fund managers in the portfolio, we understand that fund managers have a capacity limit and they can only manage money up to a certain level. And so we would have that threshold. And when the fund manager gets close to their 10 or 15 billion or 20 billion, whatever we think is where the limit is, we then sell out. The manager still might do reasonably well and continue to perform, but that's when we think it goes X growth and we would sell out. So that's the sell discipline. The other part to the sell, so the parts of the sell discipline are X growth, clearly. It's where we think the thesis is broken. So we would have bought a company on a particular rationale, like expanding stores or something, and then the management do something that says, well, that they're not following that process to where we think it should go. That would be a sell. We do sell on valuation. So if the share price gets really out of kilter and that internal rate of return drops to being negative, so we sold WiseTech. It's a fabulous growth business. They've got a runway made in heaven. But doesn't matter what we valued the terminal value at, we could not get it to be an internal rate of return that actually had a positive internal rate of return at where the share price was. So we've sold it recently, and that's been disclosed in dispatches. In terms of the overall business, it was probably too soon, but we couldn't justify paying that sort of money for that particular business. So unfortunately, we sold it, but it's a great business. There's no doubt about it.
Yeah, interesting. I find a lot of investing even becomes quite emotional, especially when you're more of a long-term buy and hold and not a very active, quote unquote trader. A lot of managers, they'll hold stocks for decades and decades. And yeah, look, as well, especially if you're a growth manager, I mean, that's one question I always ponder. How do they actually quantify what's enough, and how do they separate their own biases from what's actually happening? So yeah, good insights there. Thanks, Manny. Thank you very much for your time as well. And yeah, look forward to catching up with you next.
It's a pleasure, and thank you for taking the trouble mean, it's always a pleasure talking to you, and the support that you've given us and Bell Potter's given us has been amazing. So thank you.
No worries. All right. Thanks very much, Manny. See you later.
Chat soon.